Okay, so in this video, we're going to take a look further at the futures market, and we're going to consider the effect of operating a margin account. So typically, future markets, they operate in an environment where you are concerned about obviously issues related to default on the contract, and that can arise in different ways. But we could take the case of somebody taking a short position or a selling position on an underlying asset, let's say oil, and it's the futures price we're looking at, and then we're considering the payoff on that contract. And typically we know from analyses that if the value of the underlying asset goes up, then the futures position is costing you money, because if you're locked into an agreement to sell oil at $100 a barrel, you set that up today, the contract matures in 1 year. If a year passes and we find that you're locked into selling at this 100, the delivery price K, when the price in the market had went to, let's say, 150, then you're forced to sell at the low price when the true market value is actually turned out to be much higher, a loss of 50. So in a situation where you have a counterparty and they are losing under position, the question arises typically, will they honor their agreement? This 50 here that the counterparty is now having to deal with, they obviously have an incentive to walk away. And what the margin account provides us with really is a solution. And the solution is, how do we deal with credit risk? How do we minimize or mitigate credit risk? Okay, so it may not completely eliminate the credit risk, but I suppose we can say it mitigates. And it's a remedy that is relatively inexpensive. And it's also a remedy that, if we consider the recent legislation, not too recent perhaps, 2010, the Dodd-Frank Act 2010, and then subsequently in Europe, we had the European Market Infrastructure Regulation, and that was straddled over a couple of years. But essentially, same idea, that for the over-the-counter market, what is proposed is like what we see on formal standardized future exchanges where you have clearinghouses. The Dodd-Frank and EMIR demand that the over-the-counter market introduces solutions in the form of a centralized counterparty that institutes, if you like, centralized counterparty, which institutes a clearinghouse in the market that intermediates. So if we have A and B and they are trading, so we have two counterparties and they enter into a futures position, then with a centralized counterparty, a CCP, they stand in between and they operate the equivalent of a margin account, where basically collateral, once you open a position on a futures contract, you must subscribe either cash or some other security which acts as a form of collateral. Thus, in the event that one of the counterparties, distinct from the centralized counterparty, one of the traders, right, if they decide it's not in their interest to honor their side of the agreement, either during the life of the contract or at the maturity, their position close to maturity, they can be closed out and funds in the margin account can be used to compensate the party who stood to lose out on non-payment or the default of the other counterparty. So if you have a position, again going back here, where you decide to take the short position, instead of that being creating profits, it was generating losses. How do we ensure that the counterparty with the short position, we can think of, for every long position, there must be an offsetting short position. If one party is gaining, then that means that the other party, counterparty, is losing, right? How do we prevent this B, right, from walking away from the deal? And what's the question we might raise is, what skin in the game heuristic can we impose here, right? What ties us together? What's the glue that binds together the different counterparties, that no single counterparty would see, okay, it is now in our interest to walk away and let somebody else pick up the tab, okay? So this is an agency problem, and a very simple mechanism for resolving this is the margin account approach, the operation of a margin account. So what we're going to take a look at here is, I'm going to take an example from John C. Hull and options futures, and I have a few references, option futures and other derivatives, that textbook. And we're going to take a look at an example that he provides. I think it's normally chapter 2. There's as many as, I think, 11, 12, maybe 13 editions now of John's book. And normally in chapter 2, he examines a little bit the microstructure of the futures market. And typically there's a fairly good account of how a margin account would operate, right? Margin account operation. Also in the Robert Schiller's lecture, I think it's University of Yale, and I think it's I'll find the reference for that. It's on the Vinegar Hill website. I'll leave a link to that on the relevant page. But he has one lecture on the futures market, and there's a whole section devoted to a discussion around the margin account, and that's very, very valuable. Also, just for a little bit of intuition. So basically, what's the idea then in terms of taking John's example and examining the timing of the cash flows and how the margin account might operate? So the starting point with John's example would be there's a futures contract, and it is an investor goes long, and it's on two contracts where the maturity is in December, and the current time period is June. So if we're building a timeline, we'd say we're in June, we're looking to December, and we're currently, this is the current time period, and we're setting up, and that's a 6-month interval, and we're currently setting up the purchase of 2 contracts, and each contract is equivalent to 100 ounces of gold. So in effect, we're going to buy 2 times the 100 ounces, and that's a long position, right? And the current futures price is 400, right? The current futures price is $400, right? And that then becomes the delivery price. So like always, when we look at the timeline here, the futures price in June is 400, right? Is 400. And that's by, once we've negotiated the contract, that then becomes the delivery price, or K, right? That then becomes the delivery price. So if the price goes up, we're gaining on the position. If the price falls, we're losing on the position. It's a negative being imposed on us, and the clearinghouse will deduct that out of our margin account. Okay, so that's basically the starting point here. Now, how would the margin account operate? How does the margin account operate? And there's a few, I think, basic ideas probably we should take a look at. First of all, there is an initial margin. There's an amount of money, initial margin. There's an amount of money that we must subscribe into the margin account, right? And then once we've subscribed that, we've got to ensure that the value of that margin, if it falls, it doesn't fall below a key critical level. So there's an initial margin and then a maintenance margin. And if the value of the funds or security, we could put in, for the initial margin, we could either put in some kind of cash amount, or we could put in an acceptable security, like a stock or a bond. But if we put in a security, typically the clearinghouse will impose what's known as a haircut, and that might be maybe 10%, or if the asset was quite risky, it could be as much as 30-40%, right? So you put in, you subscribe capital or collateral as initial margin, that goes into the clearinghouse, and then we have to maintain that margin. And that means that, yes, if the value of the asset falls over the life of the futures contract, money is taken out of the margin account. And then if the value falls below some critical threshold, so this maintenance margin we might view as a threshold. If the value falls below that threshold, we've got to top back up, and the clearinghouse will send out what's known as a margin call. In other words, you need to top back up. It's a top up, and you need to top up the funds in the margin that you restore back to the initial margin. That means when we look at our counterparties A and B, and then we look at the clearinghouse, right, which is also a party here, right, that if let's say B is losing funds or has a losing position, that B is not incentivized to walk away. That B must adhere to the terms of the original futures contract. And if they're losing funds, then B has got to put more funds back into the exchange, right? And that's important, right? So there is no incentive to walk away here, or it's not easy to walk away. Now, how might that work? Okay, we might take a look at, we'll just pause for a second and I set it up. Okay, so just to be clear, right, Okay, so what an effect we have before we get into set up our numbers in a spreadsheet. We're saying, if you recall, that we are going to take two long positions. So basically, we're going to have two long positions, two long contracts. The contracts are, each contract is 100 ounces. So if we multiply by 2, we have 200 ounces. Each ounce, 1 ounce is equal to $400. That's the futures price, which becomes the delivery price. Now, currently, an ounce of gold is obviously way more expensive. We're talking the thousands of euros as opposed to 400. So there's been a considerable increase in the value of gold, like many commodities. So our numbers are a little bit dated here, but that's doesn't prejudice the basic trust. So we're looking at a futures price for gold, and we're measuring gold in terms of ounces. And each contract is 100 ounces, but we have two contracts, so we have to scale everything by 200. Right? So each price movement has got to be scaled up by 200. Now, if we take the long position and the price goes up, we're gaining. If the price goes down, we're losing. And also, it's worth noting the initial margin for one contract is $2,000, but we have two contracts. So that means we've got to contribute, multiply by 2 for two contracts, then 4,000 euros. Likewise, there is an initial margin. Likewise, there is a maintenance margin, and the maintenance margin is 1,500 per contract. If we scale up by 2, then the maintenance margin is twice that 1,500, and that is 3,000. Okay, so that's our starting point. Okay, so let's then take a look. Let's transition into a spreadsheet where I have some numbers set up based on John's example. And we start off on day 0. Now, the contract is from June to December, but we're only getting the first 16 days. Okay, so this 16 days is not 16 weeks or 16 months. It's it's not 16 weeks or longer. It's just basically 16 days. And we start off with a price of $400, and that's how much each ounce of gold we have contracted to purchase at that price, and we're going to buy 200 ounces. So every price movement that occurs, we scale that by 200. So for instance, if on the first day the delivery price is agreed at time period 0 is 400, and then the following day the price falls to 397, you scale that by 200, you take the difference, it's a negative difference, and you scale by 200, and that's a drop in the value of the margin account from 4,000 that we initially contributed to a drop of 600, right? In the cumulative gain and loss, it's just the sum of this column. We'll see how that works in a moment. The initial margin is 400, and the amount of money, the initial balance in the margin account's got to be 4,000. The drop of 600 in the position means at the end of day 1, we've 3,400. Nothing happens. There won't be a margin call. A margin call only occurs if the price, if the value in the margin account falls below 3,000. Hits 3,000 or falls below, then we get a margin call. So if the value in the margin account is less than 3,000, then we must top up by an amount that brings us to 4,000. Okay, so the second day the price falls again by 90 cents. We multiply that by 200. That's a drop of 180. We now have a cumulative loss of 600 and 800. 600 and 180, that's 780. We take that away from the 4,000. We have 3,200 in our account. We're still good. The following day, the price goes up. It goes up from 396 to 298, so that's 210 of a gain multiplied by 200. We now have an increase, and that comes in our favor of 420, which goes into our margin account. Cumulatively, over the 3 days, we now have a cumulative, in this case, a loss in the position of 360. 360 away from 4,000 leaves us with 3,600. We're still good. And that continues. There's some variation in terms of going up and down. We go down, we go down. And then when we're on day 5, we're still good because our margin account is still at 3,340. Day 6, we have an additional drop of going from 39670 to 395. So that's a 130 drop multiplied by 200 to 260. We now have just above the maintenance margin of 3,000. We're still good, 3,080 in our account. The following day, another drop from 395 down to 393.30, and that's a drop of $2.10 multiplied by 200, 420. And we see now that we have a cumulative loss on the margin, on our position, trading position, of 1,340. That will bring us below the 3,000 maintenance margin, and as a result, that will trigger a margin call of 1,340. So we've got the top up, and adding this figure to this figure will restore us back to 4,000. So if at this point, if we have the long position, if we do not top up our margin account, then our position gets closed out. Okay, so what continues? What happens? The price the following day goes up slightly. There's a slight increase. We now are up to 4,060, but then the following day there's another fairly substantial drop, another slight increase, and then there's a fairly significant drop that pushes us one more time below the 3,000, and that creates an additional margin call, and we have an amount that must be paid into our margin account to the clearinghouse that takes this 2,740 back up to the 4,000, and that's topping up of 1,260. If we failed to fulfill the margin call, then our position would be closed out. Now, when we look at this, what's the overall? When we get to day 16, there was some variation. On the very last day, the price went up, so there was a daily gain. We have 5,060 in the margin account. Can we estimate what was the loss on the long position? So in this case, the loss would be basically the diff would be how much money we had put in. So we'd put in 4,000 initial margin, 1,340 margin call, a second margin call of 1,260, and then at the end we subtract away what the account, the additional gains that had flowed into the margin account. So what amount was in our margin account on the final day, and the loss in the long positions, 1,000 540. Another way we could have estimated this was to basically take this initial margin, take the sum of all the margin calls, and subtract the final day, the day 16 here, and we would have got the same figure. So we took this initial. Also, if we had taken the 392.30 away from 400, that would give us 770. And then if we multiply that by the 200, that would represent the loss. Given that the price had fallen on the long position, that then appears as a loss, and that would have been 1,540. Okay, so I'm going to break here, and in the next video, we'll continue the analysis with some simulation. But the basic idea here, in terms of gains and losses in the margin account, and how the margin, initial margin, maintenance margin, and loss on the position or gain on the position can be worked out. We can see that in the set of numbers provided here.